August 2024. Japan's central bank raises interest rates by a tiny fraction, 25 basis points, 1/4%. Sounds trivial, barely noticeable in normal circumstances. 3 days later, $2 trillion evaporated from global markets. Stock indices crashed. Bitcoin dropped 23% in hours. Panic selling across every asset class. Trading halts triggered. Circuit breakers activated. That wasn't a crisis. That was a warning shot. A preview. A small taste of what's coming when the real unwinding begins. Because underneath the surface of global finance sits a $20 trillion ticking bomb. 15 to 20 trillion, according to Bank of America estimates. All built on one assumption, that Japan would keep interest rates at zero forever. That free money was permanent. That the greatest financial cheat code in history would never end. That assumption just died. And when $20 trillion of leveraged positions start unwinding simultaneously, when hedge funds face margin calls they cannot meet, when forced liquidation hits every asset class at once, your portfolio doesn't care how good your companies are. Apple could have record earnings. Nvidia could be printing money. Bitcoin could have perfect fundamentals. Doesn't matter. They're all getting sold. Not because they're bad investments, because funds need cash immediately to cover Japanese yen liabilities. And they'll sell anything liquid to get it. This is finance through time. And this is the story of how Japan's interest rates are about to trigger the largest forced liquidation since 2008. Let me explain the cheat code that broke global finance. The trade that seemed too good to be true, because it was. For 30 years, Japan maintained interest rates at essentially zero, sometimes negative. They had deflation, stagnant economy, demographic collapse, so they kept money free, hoping someone would borrow and spend. Meanwhile, the United States had higher interest rates. Not dramatically higher, but enough. Treasury bonds paying 4 to 5%, corporate bonds paying more, stocks generating returns. Smart money noticed the gap, realized they could exploit it. The trade was beautifully simple. Step 1. Borrow yen from Japan at 0% interest. Massive amounts, billions. The borrowing costs nothing. You're essentially getting free money as long as you pay back the principal eventually. Step 2. Convert those yen to dollars. Take the borrowed Japanese currency and exchange it for US currency at prevailing rates. Step 3. Buy US assets. Treasury bonds paying 4%, corporate bonds paying 5%, stocks in growing tech companies, real estate generating rental yields. Step 4. Collect the difference. You're paying 0% to borrow, earning 4 to 5% on investments. The gap is pure profit. Risk-free arbitrage. Free money. This is the carry trade. Borrowing in low-interest currencies to invest in high-interest assets. And when the low-interest currency is literally zero, it's the financial equivalent of a perpetual motion machine. Hedge funds loved it. Pension funds used it. Investment banks built entire trading desks around it. Japanese institutional investors borrowed in their own currency to buy foreign assets. Everyone participated because the math was undeniable. And then they leveraged it. Because 4% annual returns aren't exciting, but 4% leverage 20 times becomes 80%. Now we're talking real money. Real bonuses, real performance fees. So they borrowed more, used borrowed yen to buy assets, used those assets as collateral to borrow more yen, repeated the cycle, built enormous leveraged positions on the assumption that Japanese rates would stay zero forever. The position grew and grew, 5 trillion, 10 trillion, 15 trillion. Bank of America estimates $15 to $20 trillion in carry trade positions globally. Not billion, trillion, with a T. The entire structure of global finance rested on Japanese rates staying at zero. U.S. stock market valuations inflated by leveraged yen money, treasury markets supported by Japanese buyers, real estate prices boosted by foreign carry trade capital. Everything connected through this one trade. But mathematics always wins, and Japan's mathematics stopped working. For 30 years, Japan could maintain zero rates because they had deflation. Prices weren't rising, economy wasn't growing, no inflation pressure, so zero rates weren't dangerous. They were necessary just to prevent outright economic contraction. Then things changed. COVID stimulus, supply chain disruptions, energy price shocks. Suddenly, Japan has inflation. Real inflation, not massive, but enough to matter. 3 to 4% annually, combined with yen currency collapse. The yen weakened dramatically against the dollar, lost 30% of its value in 2 years. This creates imported inflation. Everything Japan imports, primarily energy and food, becomes more expensive. Now Japanese citizens are experiencing real cost of living increases. Food prices rising, energy bills rising, standard of living declining, political pressure mounting on the central bank to do something. And there's only one thing central banks do when inflation appears. Raise interest rates. It's their only tool, their only response. Doesn't matter if it breaks the global financial system. Domestic mandate comes first. So Japan starts raising rates. Slowly, carefully, but meaningfully. from 0 to 0.25%, then to 0.5%. Their 30-year bond yields hit 3.9%, highest in decades. This breaks the carry trade mathematics completely. Remember the trade? Borrow yen at 0, invest in dollars at 4%. Profit is 4%. Now you're borrowing yen at 0.5%. And the yen is strengthening as rates rise. So when you convert dollars back to yen to repay your loan, you need more dollars than before. The currency moved against you. Suddenly, your 4% profit on US assets isn't profit anymore. You're paying interest on yen borrowing, losing money on currency conversion, and facing margin calls because your leveraged positions are underwater. The math inverted. The free money disappeared, and $20 trillion of positions are now losing money simultaneously. This is where it gets personal, where it hits your retirement account, your stock portfolio, your crypto holdings, because you're about to get hit by selling pressure that has nothing to do with the quality of your investments. Hedge funds have massive yen liabilities, billions borrowed at 0% that now needs repaying. And the yen is strengthening. Every day they wait, they owe more in dollar terms. They need to close these positions, need to repay the loans, need cash immediately. How do you raise billions in cash immediately? You sell assets, liquid assets, things that trade with volume, things you can dump quickly without completely destroying the price. US tech stocks? Perfect. Apple, Microsoft, Nvidia, Amazon, massive daily volume. Can sell billions without completely cratering the market. Sure, prices will drop, but you can get out. You can raise the cash. Treasury bonds, also perfect. Most liquid market in the world. Trillions in daily volume. Sell billions in treasuries. Raise dollars. Convert to yen. Pay back Japanese banks. Bitcoin and crypto. Highly liquid. 24/7 markets. No circuit breakers. Perfect for emergency liquidation. Dump your crypto holdings. Raise cash. Cover margin calls. None of this has anything to do with whether these investments are good or bad. Apple isn't failing. Nvidia isn't losing market share. Bitcoin isn't broken. These are forced sales. Liquidations driven by balance sheet requirements, not by fundamentals. And when multiple hedge funds are doing this simultaneously, when pension funds are unwinding positions, when Japanese investors are repatriating capital, the selling pressure becomes overwhelming. You watch your tech stocks drop, not because earnings are bad, because someone in Tokyo needs to cover a yen loan. You watch Bitcoin crash, not because adoption is failing, because a hedge fund needs dollar liquidity immediately. This is indiscriminate liquidation. Everything liquid gets sold regardless of quality. When everyone rushes for the exit simultaneously, the door isn't big enough. Prices collapse not from fundamental problems, but from technical selling pressure. And it gets worse, because normally diversification protects you. Normally, when stocks fall, bonds rise. Flight to safety. Capital moving from risk assets to safe havens. The classic 60-40 portfolio, 60% stocks, 40% bonds. Bonds protect you when stocks crash. Not this time. This time bonds are getting sold too, because Japanese investors hold $1.2 trillion in US Treasuries. They're America's largest foreign creditor after China. And they're sellers now. Why? Because yen strengthening means their Treasury holdings are losing value in yen terms. They bought Treasuries when dollar yen was 150. Now it's 130. They lost 15% on currency alone, even if Treasury prices stayed flat. So they're selling, repatriating capital, converting dollars back to yen, taking their Treasury holdings and liquidating. $1.2 trillion of selling pressure hitting the bond market. This means Treasury prices fall, bond yields rise. The safe haven isn't safe. Stocks are falling from forced liquidation. Bonds are falling from Japanese repatriation. Your 60-40 portfolio is 40-40. Everything is down simultaneously. This is correlation breakdown. The diversification that was supposed to protect you fails because both asset classes are experiencing technical selling unrelated to fundamentals. You can't hide in bonds because bonds are being liquidated too. The entire architecture of modern portfolio theory assumes stocks and bonds move inversely, assumes flight to safety during crises, assumes diversification provides protection. All of those assumptions are breaking when the crisis is forced liquidation across all liquid asset classes simultaneously. So what happens next? How does this resolve? Who stops the bleeding when $20 trillion needs unwinding and everyone's selling everything? Only one entity can. Only one institution has the balance sheet, the Federal Reserve, central banks, the money printers. They'll have to intervene, buy assets, provide liquidity, prevent complete collapse. But can they? Do they have the credibility? Do they have the political mandate? Because we just spent 3 years fighting inflation, raising rates, reducing balance sheets, telling everyone the era of free money is over. Now they face a choice. Let the carry trade unwind naturally. Let hedge funds fail. Let markets crash. Let the liquidation play out. Accept the pain. Or print more money. Bail out the system. Restart quantitative easing. and admit that we can never actually stop. Japan tried to normalize, tried to have real interest rates like a normal country, and it broke global finance because the entire system was built on the assumption that Japan would subsidize everyone else forever, that zero-rate yen would be available infinitely, that the carry trade could run eternally. That assumption died. And now we find out whether the system can survive without it, whether global markets can function when the free money spigot actually turns off, whether all those asset valuations were real or just artifacts of leverage built on Japanese zero rates. August 2024 was the warning. $2 trillion gone in 3 days from a tiny rate hike. That was the test. The real unwind is coming when Japanese rates hit 1%, when yen strengthens to 120, when those 15 to 20 trillion in carry trades all need to close. Your stocks will fall, your bonds will fall, your crypto will fall, not because your investments failed, because the free money era ended and the bill is coming due. This is finance through time. We follow the money to show you that nothing was ever as safe as it seemed. So here's the question. When this $20 trillion bomb explodes, when forced liquidation hits every asset class, do you think the Federal Reserve will have the courage to let it burn? Or will they restart the printing presses and admit we can never actually escape the free money trap? Drop your thoughts in the comments. Let's discuss whether central banks can ever actually stop, or if we're trapped in this cycle forever.